and share my screen. And say, Anna, take it away.
Good morning, everybody. I appreciate you taking the time on this Friday morning to further your industry education. I think it's super important that you stay on top of things, put yourself in the know for things that are changing or just new things. I'm a big proponent of continuous education. So, as Jennifer said, I am Anna Gettman. I've been doing this for about 26 years and been known to hold almost every single position in the title and escrow side of things. So today we're going to be talking about alternative financing, and our agenda consists of escrow and title requirements on assumptions, wraps, also known as all-inclusives, and subject to financing. Guidelines, we're also going to go through some guidelines for seller carrybacks. That's where the seller carries the note and deed of trust. And then also going through some guidelines for private money lending. We are seeing that more and more in the last 9 months. And then how down payment programs can affect future transactions. I just recently had an issue with one of my transactions that the seller was unaware of, so that will be shared later on in the class. And then the bonus topic is something that has been on the horizon for the last, I want to say maybe 6 months, and will be the new absentee owner guidelines on sale transactions, which is super important. That's why we felt like it was necessary to throw that into the class today, even though it wasn't a scheduled topic. And at the very end, if there's any questions that need to be answered, if I hadn't answered them already throughout the class, I will be happy to do so at the end. So as we all know, we deal with contracts day in, day out. There's fine print, there's, you know, all the good stuff that you do need to be disclosed and know of, but there's just so much that it's itty bitty. This seminar is designed to explain what escrow requirements are for transactions and not to advise and or on recommend financing strategies. So we're not here to advise you how to do your transactions. We're just here to educate you should you have these scenarios in your transactions. And before utilizing any of these strategies, it is recommended that all parties consult their tax professionals or attorneys, because we are not licensed tax advisors. We are not licensed attorneys. We come across these scenarios, but so it's important that we educate you in what is the requirements, but we will never, ever, ever advise your clients when it comes to these two areas. And then in our volatile insurance situation, which I've actually personally experienced myself, it is critical that the seller buyer check with the hazard insurance agent for direction on insurance. With all the insurance pulling out of California, and not even pulling out, but dropping people, existing clients, getting insurance is tough. So you can imagine if a scenario is being changed within a real estate transaction, it might throw the insurance company for a loop, and the insurance company may choose to not insure that property any longer. So having said that, when would you use alternative financing? So that's a good question. It's a loaded question. And so hence the class, but you would, when there is a need for short-term financing while other financing is being put into place. So to elaborate that a little bit, you have to understand what position your buyer is in and what position the seller is in before you want to dive into any of these. So, and when it's all short term, because the buyer needs to be able to obtain permanent financing, long-term financing down the road. So that's why it's very important for you to understand what seller and buyer, what the positions that they're in before you either suggest these things or start going down the path of these things. So when a buyer does not qualify for traditional financing, so for instance, these higher interest rates that we've seen in the last 9 months, it's almost, for some of these buyers, it's almost impossible for them to qualify for a loan because of the higher interest rates. They simply cannot make those payments or qualify to make those payments. And we came out of a fantastic time of lower interest rates where they were in the high 2s, low 3s. So where the seller may have obtained financing when those interest rates are super low. So there's a huge gap from 18 to 24 months ago to date. It could be as much as a 6% gap, which is a lot of money, and it plays with a lot of purchasing power for the buyer. Also, when the seller believes there is a benefit to offering private financing to earn reasonable interest, just like I said, when there is a larger gap, of course, it's not going to make sense for the seller to charge. For instance, if they have a 3% interest rate, it would not make sense for the buyer to charge an 8% interest rate because that's what the institutional lenders are charging. So for instance, in this case, maybe the buyer could afford a 5% interest rate. So that seller has the opportunity to make 2% of interest on their money, or the lender's money, for that matter. The car seller financing addendum gives us clear instructions on how to prepare our documents. I do want to spend a little bit and emphasize a little bit on this form. We are not going to tell you how to fill this form out, but I want to emphasize that it's very important that you understand how to fill this form out, because we require a lot of this information to be provided to us, whether it pertains to your situation, transaction, or not. It's going to, if it's not filled out completely in its entirety, you're going to get your escrow unit asking a lot of questions, which is going to delay your transaction. I know it's would just be just as easy for us to tell you how to fill the form out, but it's actually illegal for us to tell you how to fill the form out. For instance, a lot of people don't understand the tax service fee, or the tax service, actually. They don't understand how that works, and they don't, and so I suggest you get with your broker and maybe have a little tutorial session on how to fill out this form, because it's super important when you are in these type of situations that all this information is addressed, especially because you're most likely going into a situation where the seller is not completely educated into what they're getting themselves into, as well as the buyer. So it's very important that all parties understand what this form is asking and what they're agreeing to. So again, suggest to go to your broker and have a little bit of a tutorial session in regards to this form. Things to know in an assumption. An assumption is a loan. In a loan assumption, the new borrower, the person assuming the loan, is in exactly the same position as the person passing it on. They'll have the same terms and conditions, the same mortgage rate, and the same remaining repayment period, and the same mortgage balance. I just ended up closing a assumption loan about 2 weeks ago. And these type of scenarios do not, they can't close very quickly, because you are having to get the permission of the existing lien holder the existing lender, they have to authorize the assumption of the loan. So basically, the new buyer borrower has to get approved to assume that specific loan. So it could be a little bit longer than a normal loan process, as if the buyer was going and getting out a new fresh loan. Only because these type of transactions, they don't have a lot of departments and representatives that do that, because it's few and far between. And so that they have their process and their quote unquote, for the lack of better words, underwriting does take a little bit longer. So basically, the new borrower must qualify, like I said, for the loan, and the down payment is usually larger to meet the purchase price of the property. And again, every scenario in an assumption is different. Not all assumptions are the same. So there's different requirements, different criteria. It all depends. It's a case-by-case basis. And on every lender has different assumption requirements. Having said that, not all loans are assumable. Okay. And so they have to have the assumption clause in the existing loan in order for them to be assumable. And it's just a quick phone call to the existing lender to see if you're not if the seller is not aware whether their loan is assumable or not. They can just go ahead and pick up the phone, give their lender a quick call, and ask them that specific question. Again, these transactions, like I said, can be lengthy and can take up to 6 months. Especially with our moving market, that statement rings truer than not, because the market is constantly changing, and these lenders are a little bit apprehensive to approve certain things outside of the box. So the things that you need to know about subject to transactions. What is a subject to transaction? A subject to agreement is an informal agreement between the parties, between the buyer and the seller. And what that means is there's an existing mortgage that is neither going to be paid off or assumed, approved by the existing lender. So there is a loan on title that the seller has taken out and is making monthly payments, but the buyer is going to purchase the property, and the buyer and the seller are agreeing that that buyer is going to buy the property and continue making payments to that existing lender, where that existing lender is not going to be notified that someone else has taken ownership of the property. They will be receiving payments from that person, but that's actually not out of the ordinary, and they really don't, I shouldn't say they really don't care, but they don't take a huge notice on where the payments are coming from, because as long as the payments are coming in, they just go on their merry way. So like I said, the buyer makes the payments. Whether that payment goes directly to the lender or servicing, there's a little bit of a risk, because that note is still, that mortgage is still under the seller's name, and they are counting on that buyer to make that payment directly to their lender. Now, having said that, there is no legal obligation for the buyer to make those payments, because it's an informal agreement. So for example, we get an escrow, buyer says, I want to buy this property, I'm going to take over their loan, we're not doing an assumption, so on and so forth. And the lender is not notified. They provide documentation where the seller says, this is my loan balance, this is my interest rate, this is a copy of what my terms are. The buyer says, okay, I'm good with that. And there's a credit debit within escrow. Buyer brings in their closing funds, seller get, if it's above and beyond what is being assumed, what is being subject to. If there's proceeds, the seller will get their proceeds, we'll close escrow, all fine and dandy. But like I said, this is a very high risk situation for the seller, because should the buyer not make those payments, that yes, the foreclosure will start to happen, but the seller's credit will be affected. Okay. So I have had these. I have never heard of it going sideways. I have never heard of the buyer not making the payment, because at the end of the day, the buyer, even though there's no legal obligation for the buyer to make that payment, at the end of the day, they still have invested money. And if they don't make the payment, the foreclosure will happen, and then they don't have any real estate that they've invested money in. So again, it is risky, but I've never heard in the last 26 years that this has gone sideways, or a buyer has failed to make the payments and the property was foreclosed on. So
Anna, would you say in your experience that it tends to be done between family members or other people who know each other very well?
In my experience, I've had maybe a handful of family members. The other 50% are basically investors, because they're going to end up paying off that loan anyways when they turn around to sell that house. So they're not very concerned about getting an assumption, getting all of that. They want a quicker escrow. So 50% are family members or people that know each other, and the other 50% are investors, because that mortgage is not going to exist soon after.
Can you mitigate some of the risk by having the buyer make the payments directly to the seller, and the seller takes care of it to make sure their credit's not damaged if there's payments missed or something like that?
That risk is alleviated, but then another risk happens. What if the seller doesn't, just pockets the money and does it because they no longer own the property and they don't care about their credit? So you're trading one risk for another. Does that make sense?
Yes, it does.
Yeah. So so in this, oh, can you go back real quick? Sorry. In this scenario, escrow prepares only a document signed by all parties regarding the subject to agreement. The subject to is not covered by the title insurance. So the only thing that title is insuring is the owner's policy. We're not insuring above and beyond that. And we definitely get an amendment stating that the buyer and the seller understands what they're getting themselves into on both sides. Okay. Now you can move on, Jen, sorry. Things to know in a wrap, also known as an all-inclusive. You might hear all-inclusive deeds of trust, you might hear the word wrap. It's just a matter of who's doing business, how long the person that's been doing this has been doing business. We used to call them wraps way back in the day. And now, and then it's been a while that they've been, the all-inclusive term has been deemed that this is how the transaction is supposed to be referred to. So what a wrap is a wraparound loan that involves the seller's mortgage on the home and adds an additional incremental value to arrive at the total purchase price that must be paid to the seller over time. So this kind of piggybacks on the subject to, because in this scenario as well, the existing lender is not notified. They're not being requested for an authorization to assume the loan. So it's just an extension or a piggyback on top of a subject to where the seller wants to maybe retain some beneficial interest into the property. So it does encompass the outstanding debt due on the property plus the amount that covers the new purchase price. For example, I'm selling a house for $200,000. I have a mortgage on there for $125,000. Well, I've paid it down some and say I only owe 100,000 at the time of me selling the property. But I'm going to sell it, and the buyer is going to agree that we're going to keep that loan, and now I'm going to add an additional 25,000 that I'm going to be a beneficial interest to. And so now that loan still stays as first position. Now we have had a second loan in second position, and I, the seller, am the beneficiary of. So now, then when all the numbers are said and done, the first loan balance is being taken into consideration. We're adding the second, and then whatever's left over will be my proceeds. But the buyer is still paying that $200,000 sales price and has to bring in the difference between the first loan and the second loan and the sales price. Of course, plus or minus any proceeds and closing costs. So I think that's basically what I just said, but in the wraparound loan, the buyer makes the loan payments to the seller. The seller then continues to make payments on the original mortgage. Essentially, the buyer is paying the seller, and the seller is paying the original mortgage with the buyer's money. This arrangement allows the buyer to purchase the home without having to secure a loan from the traditional lender. So what's happening is the buyer is not making two separate payments. The buyer is only making one single payment to the seller. The seller is taking, at that point, taking their piece of the pie and then giving the rest of it to the existing lender for their normal mortgage payment. Okay, a servicing company for a fee can accept the payments from the buyer and make the correct payments to the lender and the seller. So in this scenario, where in the previous scenario there was some risk, so in this scenario the servicing company can alleviate that risk by accepting the payments from the buyer, giving the seller their portion, and passing on the rest of the money to the existing lender. Okay. So in this, things to know in a wrap, continuing all-inclusive, no escrow or an attorney will prepare an all-inclusive deed of trust and all-inclusive note. These will reference the note and deed of trust. So we typically prepare these. I've had maybe one instance where an attorney would prepare this, and the only reason why is it doesn't happen very often. So the attorneys end up, when they prepare them, it causes more questions than anything. Because we have to make sure that all the clauses are covered and everything is taken care of. And there's no loopholes, and everybody understands what the risks are, and everybody understands what they're getting themselves into. Escrow will require the original note or a copy and a mortgage statement from the document for document preparation and proration. So the seller will have to provide a beneficiary statement showing, what the principal balance is left, even though the original, like I said, the scenario I gave where the original loan amount was 125,000, but it's now I only owe 100,000. So that is the whole thing. I'm not giving them, they're not taking 125,000. They're not paying on 125,000. They're only going to be paying on 100,000, if that makes any sense. A wrap cannot be done with an FHA and most VA loans. There is a specific type of VA loans that this can be done with, but it's very, very, very rare. So the only time that you should be doing this and this can be done is the loan must be a conventional loan. Because if this is done on a FHA or VA loan, that is not allowed for it to be done. If we were to do, or any title company were to do that, it would be a hefty, hefty fine, a big penalty, because it's a big, big no-no for these type of government-backed loans. Okay. There was a couple of questions I saw pop up, or statements, before I move on to the next one, just so I can address them. about the due on sale clause. When we prepare our escrow instructions, in our escrow instructions, it's in there that the buyer is aware that there is a due on sale clause for these type of loans, and that should the lender be notified in some way or figure it out, that they understand that that note may be called due. So we make sure that, and that was another reason why we like to prepare all the documents in lieu of an attorney. Not to say that we're smarter than them or that we know better than them. It's just we need to make sure that all parties understand, again, what they're getting themselves into, and that that unsuspected lender can catch wind and say, nope, sorry, we have a due on sale clause. If this property was ever sold, our note must be paid in full. So notice of risk due on sale clause being triggered should always be part of subcontract. Yes, I mean, if there's a contract outside of escrow between the buyer and seller, that should be part of it. But just know that if it's not, and it gets to escrow, I'm hoping, whichever escrow officer you're using, that they are versed enough that they know that they need to put that in their escrow instructions, that the buyer is aware that that note has a due on sale clause. Okay. Okay, we can move on. What is a seller carryback? When the seller provides all or part of the financing for a buyer or real property, we refer this to as a seller carryback. So for instance, I'm selling a property for $200,000, and my mortgage is getting paid off because the buyer's getting a first mortgage to buy the property. But just say that first mortgage, they just couldn't qualify for a certain amount. You can do a seller carryback as second. That's one scenario. Another scenario, say they just didn't qualify at all to get a mortgage. The seller has the option, and there must be enough equity to where, not enough equity, the buyer, there's two different scenarios that could happen. The buyer could have enough money to put down to pay off any existing loans, or most cases when you see a seller carryback is when the property is free and clear, meaning there is no mortgage, there's no deed of trust, and they have the ability to carry a note for a certain amount. If they're going to carry back 100% of the purchase price, they're going to carry back 80% of the purchase price. That's when oftentimes you're going to see a seller carryback. I have had instances where the seller carryback was a second behind a institutional first. But that's most of the times you're going to see it to where the seller actually has a free and clear property. So in seller carrybacks, and actually to reference the all-inclusive, this is an example of many notes that can be drawn up by escrow. So if this was an all-inclusive note, it would say all-inclusive. No, it's going to identify the type of loan. So in this case, a seller carryback, you can have a straight note, you can have an interest included note, you can have an interest, straight note. There's interest only, and then just straight payments. So there's various notes. So referencing back to that seller financing addendum or any other financing addendum, it's super important that this is why that information needs to be filled out accurately and as much as possible, because we use that form to create this document. And if you just kind of skim this document a little bit, you'll understand that if we aren't given enough information, it causes questions for us. Like, because we can't assume, escrow doesn't assume, we take instruction. We never, ever, ever assume. We don't, there's that saying, I'm not going to say it, but we don't assume. So we ask questions, but this is the example of why, because we have to create these type of documents. Okay. This is a continuation of that document. Again, one of the questions that we would need to ask, or we would need to know if there's a prepayment penalty, which that form does address. If there's a late penalty, if there's, you know, what the situation is. If there's a balloon payment, there's certain transactions that a balloon payment is not allowed. And we will notify you if you fill out that form saying there's a balloon payment and the type of transaction or property doesn't qualify for that, we will let you know. Okay. And then the deed of trust. A lot of the deeds of trust are just going to be boilerplate because the deeds of trust in the state of California has been, it's a boilerplate. It's the same clause, the same disclosures, same everything, depending on the type of loan you're doing. But most deeds of trust are going to look very similar, if not the same. And so a short form or long form basically is the difference of how much we are going to need to disclose to the public, because this is a document that gets recorded and it's now the public has access to it after it records, and between the agreement between the two parties. Okay. An amortization schedule. So we can run these prior to you trying to figure out what kind of scenario you're going to enter yourself into, or your parties are going to enter into. So if you're trying to run a scenario where the buyer can only afford a certain amount of a monthly payment, and you just can't figure out what that interest rate needs to be, whether it's a seller carryback, whether it's an all-inclusive for the gap, you can give us a call and we can run these amortization schedules for you. We can run them backwards to where we can plug in what the payment you want it to be. And then we can let you know, we can run it backwards to where if this is the payment you want, and this is the loan amount, like in order for that payment to be that amount, this is what the interest rates needs to be. So, but this will be provided if, you can ask for this at the beginning to figure out your scenario. And then also once we're in escrow and these documents are typed and they're sent out in the package, an amortization schedule is going to be part of that package for the buyer to approve, so they understand what their monthly mortgage payment's going to be. And then it shows like how much of it's in principal, how much is interest, and what happens to the principal balance every time they make the payment, and so on and so forth, depending on the amount of years, the term, whether it's 10-year loan, but amortized for 30, or if it's a 30-year loan, amortized for 30 years. So different scenarios that you can have, but we, like I said, definitely can run that for you at the beginning, but you'll get one of these with the closing documents. What if there's another lender on the property? Sorry. So an institutional lender will want to have first position, like always. In their lien and their deed of trust. The seller financing will be secondary. Okay, like I was giving you an example, that seller carryback, which is a first and then, you know, a small second that the seller will carry. And the first position lender will have to approve the secondary financing. So oftentimes they're going to want to see where that money is coming from after the first institutional lender's funds or loan. And so they either have gift funds, or they actually have the money, or they are going to do a seller carryback. So that seller carryback second oftentimes will have to be approved by the first institutional lender. Okay, with all the alternative financing discussed in this presentation, the property is transferred to the buyer at close of escrow. Okay, if the borrower fails to pay in accordance with the terms of the note and deed of trust, the seller/lender, because remember, sometimes the seller is the lender with seller carrybacks, will have to go through the foreclosure process to gain the property back. Exception is on an assumption the lender will foreclose. And I remember when we were talking about that that's a risk where the buyer doesn't make any payments, the lender will foreclose. So on the assumptions in the seller carryback, should payments not be made for a certain period of time, the seller will have to go through the foreclosure process to be able to gain that property back. The seller is issued a lender's title policy to protect their interests only with a seller carryback or an all-inclusive wrap. Okay. What are the servicing options? I mentioned a few earlier, but payments can be sent directly from the buyer borrower to the seller lender. So that's your first option. Payments can be made to a third-party servicer. The servicer will charge a fee, but will take the responsibility for the collection of the funds. This does not apply to the assumption, okay? Because remember, the assumption, they're either assuming the whole loan or, well, yeah, they're either assuming it. Can the seller sell or assign the note to someone else? Okay. Depending on the scenario is what's going to be your answer. So on the seller carryback, of course, they're going to be able to, and it also, there's a caveat. It's also depends on the term. But yes, they can sell their note. They can sell only their interests. Of course, they can't sell something that they don't own interest to. So yes, they can assign the note and they can sell their interest that they have extended themselves to be the beneficiary of. What if the borrower refinances or sells? Okay. Well, escrow will request a demand from the beneficiary. The loan will be paid and funds will be sent at the close of escrow. So this is all fine and dandy when it's a seller carryback or all inclusive. But it becomes a little sticky, and this is fine with the assumption, but it becomes a little sticky when on the subject twos, because the escrow is going to need a signed authorization. And if they don't need a signed authorization, they're going to need, and you're not at the same escrow company or that the initial transaction, they're going to need last 4 digits of the social, so on and so forth. So they should have the loan number if they did a subject to, but sometimes it gets a little bit difficult to order those payoffs when it's in the previous owner's name and the lender is requiring the last 4 digits of the social or a signed authorization. And so it's a little bit of an extra hoop you have to jump through, that we have to reach out to the previous owner, which the buyer should have that contact information, but you just never know. Or if something, God forbid, has happened to that previous owner, and now you're sitting where their lender requires a signed authorization and that previous owner is nowhere to be found or unfortunately has passed away. So that subject to gets a little sticky and risky. So I don't know. I mean, that's something you got to decide whether it's worth it or not. We can
Anna, we do
compare.
have a question on, do we have a recommendation of a servicing company?
No.
Okay.
We do, yeah, we don't recommend or refer to just because that is out of our realm. Those actions take place after close of escrow.
Okay.
We can prepare and record a reconveyance at the request of the lender. There is an additional charge for the service. We will need the original note in order to prepare the documents, because that note is like money. We can't have it floating out there. So we do collect it and we surrender it to the original parties in order to prepare that reconveyance. If the note is lost, we will need a lost note bond. This process can take up to 45 days or longer, depending on the application process, because we like to give it about a 15-day grace period, because there's an application process for it to get approved. And then once it gets approved, the documents get sent to us. Then we have to get the people in to sign it. And then at that point, if that is a nice cushion of 2 weeks after all the signing is taken place, the document and bonds, the declaration and bond has to get recorded. And from the day of recording, we can't do anything until day 31 after recording. So when it says 45 days, that's an estimate, because it all depends on how quickly the seller or owner of the property process their application with the bond company, and everything gets signed. So we can't typically do anything until 30 days from the time that the bond is recorded and the declaration is recorded. If a deed of trust is paid, but we don't show a reconveyance on the chain, this must be recorded prior to close of escrow or concurrent with our closing. So we must receive the recon prior to closing. So especially on all these different loan scenarios, we can't move forward on a recon to come or a letter saying that they're going to send a recon, because as we all know, people are going to do something and it just never gets done. And then we have 2 owners later and we have a nightmare chain of title, because people are no longer around, or the lender is no longer debunked or whatever, defunct or whatever you want to call it. So we don't go on, we're going to. I want to say I'm going to be a millionaire, and I don't know if that's going to happen. I'm going to. Why could down payment assistance be considered alternative financing? Okay. Every down payment assistance program has a unique set of criteria on the note and deed of trust. So there's some alternative financing that where the person can qualify. And I've heard, I haven't seen it on my desk, but I've heard of these $100,000 down payments from, I don't know, City of Fresno, County of Fresno. I've never seen them. It's never crossed my desk, but I've heard that they exist, and they've actually had escrows closed on them. But these are the type of alternative financing that you can see out there. But they do cause problems when people want to go back and like either refinance or turn around and sell. But some loans will be forgiven if the home buyer remains in the property for a certain number of years. So this is where it kind of gets a little sticky, because they either get the loan at a higher interest rate, their first, and then their second is the down payment assistance, and they want to refinance their first because it was a higher loan. But that second says, hey, if you refinance or sell the property before, for instance, I had just had one right now, or not right now, but just a few weeks ago, it says that should you refinance or sell the property before the 5-year anniversary of this loan being given, you have to pay it. Where that initially that loan was being given on the premise of them staying in that property for 5 years, and at the end of 5 years, then it's being forgiven. So now the seller is thinking, well, I thought this loan was going to be forgiven. He goes, yeah, if you're in there for 5 years, but now they find themselves in a situation where they have to sell, but they really weren't counting on paying that down payment second. So do you see how it can become an issue? If your buyer is going into this type of alternative financing, they must be aware of, like, you need to understand that you have to stay in this property or not refinance in the next 5 years. So they have to understand their future and what their future plans could be, because if they get into a situation where they have to sell, but they can't afford, all of a sudden now you're looking at a sticky situation. Some act at zero interest, silent seconds, like I just said, but must be paid off when the property is financed. So that's another alternative finance where no one makes a payment. There's no interest being accrued. But for instance, maybe it's a $9,000 second down payment assistance. They need a $9,000 as a down payment. They never have to make a payment on it. But again, doesn't matter how long they've been on the property. The moment they sell or refinance, that second has to be paid off. So unfortunately, a lot of people that go into these type of situations, for whatever reason, think that it's free money. But I don't know about you. I've never come across free money. So if you do know where there's free money, let me know. Some loans include an equity share clause. This is pretty new. This came out a couple of years ago. So basically what this is the lender gives them the down payment assistance, and they only give a certain amount. Say they give 15,000 or 9,000, but then either depending on the program, they either don't make a payment on it or it's 0 interest. But when it's time to be paid off, say they only gave them 9,000, that doesn't mean that they're going to be paid off just 9,000. They want a little piece of the pie. So they have a calculation of a percentage that they want their 9,000 plus a certain percentage of your equity when you sell. So that's something that's been new and people just are not aware. So basically the homeowner benefits from building equity in their house, but so does the lender, unfortunately. Or fortunately, because maybe it got a first-time home buyer in their home and that's their lifelong dream and that's their one and only home that they're going to have. So it's how you see it. Half full, half empty. This doesn't affect anything at the time of purchase, like I said, but when the property is sold or refinanced. So like I said, it can never be an issue if your buyer intends on being in this home forever. So this is a bonus topic, and I am knee deep in this topic right now. I was just in the Clovis office yesterday. I'm going back there today to finish up, but because I'm knee deep in it to continue training. Again, I remember I told you, I believe in continuous education. And whether you believe it or not, it's kind of a must because our world is it's ever changing. So what this is every time we turn around and we kind of try to catch the fraudsters on, just being one step ahead of them, or at least being the same step to, do some damage control or be a little bit preventative in the situation. So the new fraud thing is people are pretending to be certain sellers. They're pretending that they own the property and they're trying to sell it and profit from the sale. And they're targeting absentee owners, which means people that own a piece of property but don't live there. Rentals, investment properties, and or vacant piece of land, so vacant properties. And so it's usually a quick escrow. Usually these fraudsters are calling listing agents and saying, I need to list my property, I need to offload it. It's a vacant piece of property out in Kerman. This is just example. I'm just not, vacant piece of property out in Kerman. I just need to get out from under it. It's probably worth 60,000, but I'm willing to sell it for 40 because I need to move on. And it's just a random person calling you. You never met them. They can be whoever they say they are. So I would be very careful on these type of phone calls. They're doing this also on investment properties where, the owner's not residing there. So it's vacant. So what we're doing is we're sending out absentee owner letters. So we have the last known address. Of course, it's a mailing address from the owner. When an escrow is open, we send out a letter. We FedEx the letter. We don't just mail it because time is of the essence. We FedEx a letter saying, hi, we're Chicago Title. We have received an escrow with this property address that we show that you as the vested owner. In our effort to reduce any fraud activity, would you please contact our office and verify whether you indeed are selling your property? And it's actually catching these transactions. It's really working. But now we're taking a next step on these, and because we can send out letters all day, every day, but if we don't follow up on these letters being sent out, makes no difference whether the letters are being sent out or not. So we are now following up once we get some type of contact information, whether they're fraudulent or not, because if they're fraudulent, we have certain things now in place that we have to do for verification purposes. And if they're the fraudsters, they're not going to get far on our verification process. They're not going to want to do what we're requiring them to do to prove that they are the vested owner. So this is happening. We're in real time. I know of at least 4 that has been stopped. I'm sure that's been more, since that's just me, and we've had a lot of units here at Chicago Title. So you as agents really need to be aware that this is happening, and that you might get these phone calls. It's the likelihood of it happening to you is probably really high, because if someone else is a little bit savvy, they're going to go to the next agent and the next agent and the next agent. So this is never going to end. Once we get a handle on this stuff, these fraudsters are going to think of something else to do, and then we're going to have to figure that out. So that is the newest thing on top of all the other things that we've been having to deal with as far as fraudulent activity. But here we are at 10:54. Time for Q&A.
So if you have any questions now that you'd like to unmute and ask Anna, this is your window to do so.
I got a question. So, what kind of obligations for loan type disclosures are required for people that either do seller carrybacks or, that are, because normally a traditional lender is required to do a lot of different disclosures. So when you have a seller carryback or alternative financing, are there any disclosures required or no?
The only thing that's required is that financing addendum.
Okay.
And that will go hand in hand with all our escrow documents and, our requirements that we have that get incorporated into our escrow instructions.
Okay.
And the reason for that is they're under the threshold of the regulatory things that the Consumer Finance Protection Bureau has in place. So you
Like so many per year or something.
Per year, it's like 1 to 3 transactions should keep you on the safer side of doing lending. But if you're starting to lend money all over town, then you will be subject to those regulations and have to prepare CDs and all that good stuff.
Okay.
Good question.
Judy's asking how often we see this.
I've been seeing it quite often for the last 6 months, just because of the higher interest rates. So I would say in a good month, I would maybe see 3 to 4 different types of alternative financing within a month's time of escrows. And then what drives these types of scenarios is the interest rates when people aren't able to get an institutional loan. I think with the higher interest rates that we're coming out of and people actually obtaining loans and maybe couldn't afford a payment, maybe a year or 2 down the road, we might see some subject twos, and those are probably going to be investor driven.
And Anna, a lot of your alternative financing is investor driven now, correct? Like investors utilize these tools more often than the general public.
Yeah, the assumption that I just had was with Wells Fargo, and that was family. That was actually from a trust, parent's trust to a son. One of the parents had passed away, and the mom no longer wanted to be responsible. It was a vacation home. The mom no longer wanted to be responsible for it, so they contacted Wells Fargo and asked them, what's the chances of my son assuming this loan. And so that did take about, I think I opened that escrow in October and I just closed it, I think 10 days ago. So the assumptions is mainly family. The wraps are investor. The subject to are investors. And seller carrybacks weren't too, they were sprinkled here and there, but the other scenarios I saw more often than the seller carrybacks.
All right. Well, thank you everyone for joining us today. If you end up with additional questions, you're welcome to reach out to your Chicago title sales execs or to Anna directly. And we hope that this was beneficial to you and gave you some great info. Again, I'll be sending out the recording at the end of the day and appreciate you taking the time. Thanks so much.
Thanks, guys.
Thanks,
Have a
everybody.
good day. Happy Friday.
Enjoy your 3-day weekend. We are.